In one trading day, silver did something most people only associate with panic weeks. On December 29th, 2025, it plunged roughly 11% intraday, not after a war headline or a surprise rate cut, but after the rules of participation quietly changed. The entry ticket for leveraged exposure was raised mid-session. And when that happens, price doesn't fall because the world suddenly decided silver is worth less. Price falls because a portion of the market is forced to leave. It happened fast, not months, not weeks. The public explanation was tidy. Volatility, risk controls, prudent clearinghouse management. The mechanical reality was simpler. The cash required to hold a standard futures position jumped. The March 2026 silver margin moved to about $25,000 from roughly $22,000. That $3,000 step doesn't sound dramatic until you realize it is applied instantly across the entire leveraged ecosystem. They said this kind of move could never happen in an orderly market. They said liquidity is deeper now, that modern clearing makes sudden air pockets impossible. Yet, silver printed record high territory near $91.44 an ounce on COMEX, and at the same time, became materially more expensive to trade. The margin burden rose from roughly 7.2% of notional value to around 9%. That is a change in the physics of the market. Here's the part most people miss. Institutions already see the stress long before it shows up on your chart. They see it in the funding rates, the warehouse patterns, the delivery queues, the margin circulars, the way bids disappear at certain hours. By the time the story reaches the general public, the system has already adjusted. And what I'm about to reveal changes how you interpret every sharp move in silver from this point forward, because the real battleground is not the price screen. It's the floor beneath it. Welcome to Signal in Silver, the channel where we decode what matters before it becomes a headline. We don't do slogans, and we don't do certainty. We follow the data, the plumbing, and the incentives that move markets. If you value calm analysis that connects dots without shouting, you'll probably want to stay close. And if you're listening like the wise elder who just wants to understand what's actually happening, take a second to subscribe so you don't miss the next piece of the puzzle. Also, drop a comment with where you're watching from, because the global map of this audience tells its own story. Now, let's reconstruct the event with forensic detail, because the details are the story. In late December 2025, silver had been behaving like a market entering a new volatility regime. The price action was not a gentle climb. It was a sequence of sharp advances and sharp pullbacks that kept momentum traders engaged and kept hedgers on edge. Then, the exchange raised margin requirements. When a clearinghouse raises margin, every leverage participant faces the same binary choice: add cash or reduce exposure. There is no third option. If you don't post the additional funds, your position shrinks by force. It wasn't a mystery. It was a forced repricing of leverage. To understand why this matters, you have to understand what a futures market is supposed to do. Futures are a bridge between producers, consumers, and financial participants. They allow miners and refiners to hedge, manufacturers to lock inputs, and investors to express a view. In a healthy system, the bridge flexes, but it doesn't snap. A margin hike is like raising the toll on that bridge with no warning. The bridge doesn't collapse, traffic just clears out. And the price you see is the price of the remaining traffic, not the price of the true value of the destination. This is where the central contradiction appears. If silver is simply too volatile, then making it more expensive to trade should calm the market. But the market's most violent move occurred right as the cost of participation rose. That's a clue. The stress wasn't only volatility. The stress was positioning. When a market is stretched, leverage is the fuse. Margins are the match. And silver has a history of being the market where that fuse is shorter than people expect. The pattern is old. In 1980, silver became a cultural story, not just a commodity story. A concentrated wave of buying collided with a thin market structure. As prices surged, rules tightened, and the structure changed. The result was not a smooth return to equilibrium. It was a crash that taught a generation what liquidity really means. In 2011, silver ran again, reaching the high 40s. Then a series of margin increases hit in a quick succession. The result was not subtle. The market dropped hard, and the narrative shifted overnight. That episode left behind a blueprint. When silver rises fast, the system responds not only with sellers, but with adjustments to the cost of leverage. Price and policy move together. In 2020, during the March liquidity shock, silver didn't just reflect industrial demand fears. It reflected the scramble for dollars. Spreads blew out. Paper claims and physical availability stopped behaving like twins. Now look at the present. In 2025 into early 2026, you have record-level pricing behavior, rising margins, and a market community fixated on delivery mechanics. That combination is not random. It is a replay of the same stress pattern, modernized. So who is moving first? Not the retail trader, not the person who sees a headline and places a bet. The earliest movers are the institutions that manage the infrastructure, exchanges, clearing members, large banks that intermediate futures, and the entities that hold or move physical inventory through the recognized chains. Start with the exchange. When the CME adjusts margin, it is responding to realized volatility and to the risk of cascading defaults. That sounds neutral, but neutrality in process can still have directional effects in outcome. If you raise margin into a rising market, you disproportionately pressure the newest, most leveraged longs. If you raise margin into a falling market, you disproportionately pressure the weakest shorts. Either way, margin is a lever that reshapes the distribution of positions. Then consider the large intermediaries. Clearing members collect margin from clients, and they may impose house requirements that exceed the exchange minimum. When exchange margins rise, house margins often rise too. That amplifies the pressure. It is a multiplier that never shows up on a chart, but it shows up in liquidations. Now zoom out to the physical side. London is the center of the over-the-counter bullion system. At the end of December 2025, London Vault data listed 27,818 tons of silver, valued around $64.4 billion, roughly 27,254 bars. That sounds like abundance. It sounds like the opposite of scarcity. And that is exactly why it matters. Inventory is not a single bucket. Some metal is allocated to specific owners and cannot be touched without their consent. Some is earmarked, pledged, leased, or part of structured trades. Some is simply not in the right form or location to satisfy a particular delivery requirement on a particular timeline. In other words, the headline number can rise while the deliverable float feels tight. This is where the dislocation lives. And two markets that are supposed to move together start telling different stories. Look at the paper signal. Futures prices can swing violently because they are the price of marginal leverage. They move on positioning, risk controls, and liquidity. Now look at the physical signal. Physical markets move on availability, premiums, and the real cost to source metal in the right place at the right time. When those diverge, you get a gap that can't persist forever. Here's a simple way to see the tension without needing a single conspiracy theory. The system wants silver to be a normal commodity. Normal commodities have deep liquidity, stable basis relationships, and smooth delivery processes. But silver is not just a commodity. It is an industrial input, a monetary metal in the public imagination, and a market with a relatively small above-ground float compared to the size of paper claims that can be created on top of it. That structural feature is what creates the potential for a market dislocation. Now let's talk evidence, because stories without numbers are just mood. On February 3rd, 2026, daily delivery notices on COMEX for the February silver contract showed 190 contracts issued and stopped in that session, with month to date at 2,955. To most people, that reads like accounting trivia. But in a market where participants are watching for signs of strain, those numbers become a heartbeat. They show that settlement is not an abstract concept. It is a daily process with real counterparties. Combine that with the margin reality. If holding a position suddenly requires thousands more in cash, then only participants with strong balance sheets and stable funding can stay fully exposed. That shifts the market from broad participation to concentrated participation. And concentrated participation is exactly what makes a market more sensitive to stress. Now connect the dots. Record high pricing near $91 and change. A margin jump to about $25,000. A sudden 11% intraday drop. London Vault holdings that look massive on paper. Delivery statistics that become a daily obsession. Those are not separate facts. They are one story. The system is managing a metal that keeps trying to behave like money while being used like an industrial component. This is the part no one is discussing directly, and it's the reason for the title. A price floor plan doesn't have to be a formal announcement. It doesn't have to be a press conference. In markets, floors are often created by incentives, by policy constraints, and by what institutions are willing to tolerate. The US doesn't need to say anything out loud for a floor to exist. The floor can be implied by what must not be allowed to happen. Ask a simple question. What would it mean for silver to keep rising aggressively in a world where central banks are trying to manage inflation expectations, manufacturers are trying to stabilize input costs, and policymakers are trying to project confidence in the purchasing power of the currency? It would mean the public is watching a monetary metal signal stress in the system. It would mean a commodity associated with hard asset protection is telling a story that policymakers don't want amplified. It requires only that institutions respond predictably to incentives. If runaway silver prices create political and economic headaches, then stabilizing silver becomes quietly desirable. And one of the cleanest ways to cool a market without intervening is to tighten financial conditions around the trade itself. Margins are financial conditions. They are the interest rate of leverage paid up front. Historically, this mechanism shows up over and over. In 1980, rule changes altered what positions could do. In 2011, margin increases helped reset the market. In 2020, funding and liquidity constraints forced price distortions. In 2025 and 2026, we see the same lever being pulled in a modern procedural way. But why does this produce the sensation of a floor rather than just a cap? Because when a market structure repeatedly flushes leverage on declines, it trains participants. It reduces speculative froth. It shifts exposure to stronger hands, and it changes the character of dips. A floor is not always a line on a chart. Sometimes it is a behavioral change, where each forced liquidation event transfers inventory and position from fragile participants to durable participants. If that process repeats, the downside becomes harder, not easier, because the remaining participants are less likely to be forced out. Now, let's make the dislocation concrete in a way anyone can understand. Imagine a concert where tickets are sold in two markets. In the first market, tickets are traded electronically, instantly, and in huge volumes. People can buy, sell, and even borrow tickets to sell short, all with a few clicks. In the second market, actual tickets exist with barcodes that must be scanned at the door. If the electronic market is flooded with paper tickets, the electronic price can fall even while people at the venue are paying more for real entry. Those two prices can't stay apart forever because eventually someone demands a real ticket. Silver works like that. Paper silver trades at enormous speed and volume. Physical silver is slower, logistical, and constrained by location. When margins rise, the fast electronic market can whip around violently. The slower physical market doesn't adjust at the same pace. That creates a temporary gap. The question becomes whether the gap closes by paper rising, physical falling, or some blend of both through settlement mechanics. And that brings us back to London Vault numbers. 27,818 tons is real metal, but it is not a public pool. It is a ledger of holdings in a system where ownership matters. If a significant portion is not readily mobilized for specific delivery needs, then a large number can coexist with localized tightness. That is how dislocations are born. Now consider the psychological element. When silver approaches round numbers, the market changes behavior. At 50, headlines write themselves. At 100, it becomes a social narrative. That's why the record high print near 91 matters. It placed the market within striking distance of a number that changes who pays attention. When attention changes, flows change. When flows change, the system's tolerance is tested. So the mechanism is clear. A rising market attracts leverage. Volatility increases. The exchange raises margin. Leverage is forced out. Price dumps. The strongest participants absorb exposure. The market resets with fewer weak hands. Then the process begins again when price resumes. This is not an opinion. This is pattern. The reason it feels like something the US can't say out loud is because acknowledging it openly would be admitting that markets are not only about supply and demand. They are also about control of narrative and control of systemic risk. Policymakers prefer to present markets as organic, resilient, self-correcting. Saying, we care deeply about the signal coming from monetary metals, invites questions nobody in power enjoys. So the system uses tools that look neutral. Exchange risk management, clearinghouse prudence, bank balance sheet constraints, regulatory capital. These are all real. They are also levers. To see how institutional behavior can create a floor without a memo, consider the chain of responsibility that sits between a price spike and a systemic problem. Exchanges set minimum margin. Clearing members decide whether to demand more. Prime brokers decide whether to extend credit to clients. Risk committees decide how much exposure is acceptable in a single book. None of those committees are trying to call the price. They are trying to avoid being the last domino. Now layer in the institutions that hover around the edges. Regulators like the CFTC care about orderly markets and concentration risk. Central banks care about confidence and the smooth functioning of funding markets. Treasuries care about the perception of stability because perception is part of borrowing cost. And large industrial consumers care about predictable input costs because predictability is planning. When a metal sits at the intersection of those concerns, it doesn't need an official comment to feel managed. This also explains why silver can look calm in one data set and stressed in another. An exchange can report normal settlement. A vault report can show large holdings. Yet the marginal buyer can still struggle to source specific bars in a specific place on a specific deadline, especially if supply chains are rerouting toward industrial demand or long-term holders. In that environment, plenty of silver exists, and deliverable silver is tight can both be true at the same time, and pay attention to the timeline. When silver accelerated into late 2025, the price itself drew the crowd, but the margin change shifted the crowd's attention toward the mechanics. Once that question enters the room, volatility becomes self-reinforcing. Every participant begins monitoring every notice, every inventory update, every policy adjustment, because those details become the signal. Now, what does this mean going forward? Historically, when you see a combination of rising margins, elevated prices, and heightened attention to delivery, three broad scenarios have tended to follow, depending on how the underlying supply chain behaves. In the conservative scenario, volatility cools, margins stabilize, price chops in a wide range. The market digests the new cost of leverage and finds equilibrium. This can last longer than people expect because boredom is a powerful stabilizer. In the moderate scenario, price resumes upward pressure after the leverage washout, because the remaining exposure is held by stronger balance sheets and because industrial demand and monetary interest keep intersecting. In that world, each dip is met with quicker absorption, and the market keeps testing higher levels, not in a straight line, but in a sequence of stress and reset. In the aggressive scenario, the paper and physical signals diverge enough that settlement mechanics become the story. Not a default, not a Hollywood meltdown, but a period where premiums, spreads, and delivery flows dominate the narrative. In that world, the headline price becomes less important than the cost to source metal in the right form and place, and the market begins to talk more about basis, lease rates, and inventory classification than about candles. Notice what all three scenarios have in common. None of them rely on a single prediction. They rely on the same indicators: margin policy, delivery behavior, and the relationship between paper pricing and physical availability. So what should you watch as an observer of the system? Watch for the cadence of margin changes. A one-off adjustment is one thing. A sequence of adjustments in a short span is a different signal. Watch delivery totals and whether attention clusters around specific contract months. Watch the way price responds to sharp dips. Does it bounce with urgency or drift with apathy? That shift usually happens before the next major move. And finally, watch the language of institutions. When officials emphasize orderly markets and risk management in the same breath as record level pricing, it often means the plumbing is under stress. This is where the divide appears. There are always two groups in episodes like this. One group watches the headline price and reacts emotionally to each spike and drop. The other group watches the system's constraints. They watch margins, funding, and deliverability. The difference is not intelligence, it is attention. Information gaps become wealth gaps because institutions move first. They don't move first because they are smarter. They move first because their job is to manage exposure inside the system, and the system tells them what is breaking before the public sees it. By the time retail participants feel confident, the infrastructure is already adjusted, and the cost of participation has changed. That is why sudden drops feel like ambushes. They are not ambushes. They are the visible consequence of invisible rules. If you take nothing else from this, take this. Silver is not just a price, it is a stress signal. It's a market where leverage meets deliverability, where monetary narrative meets industrial reality, and where the plumbing matters as much as the headline. This is Signal in Silver, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. And the question isn't whether the pattern unfolds. The question is whether you're watching the floor being built while everyone else is staring at the ceiling.